Welcome back. Ripple just closed the biggest quarter in its entire history. The company is now valued at $50 billion. Its payment platform processed over $100 billion across 60 countries. It signed Mastercard, it signed Convera. It signed Deutsche Bank, and in that same quarter, XRP, the token that carries Ripple's name, crashed 40%, from $2.40 down to $1.31. That is not a dip, that is a disconnect. A $50 billion company, a $1.31 token, something doesn't add up. And today I am going to show you exactly why that gap exists, what the on-chain data reveals underneath the surface, and the 4 signals that will tell you when this gap finally closes. So let's break it all down. Let me walk you through what actually happened in the last 30 days, because the speed of this is unlike anything we have seen before. On March 11th, Mastercard added Ripple to its crypto partner program. Mastercard processes $9 trillion in payments every year across 200 countries. That is not a pilot. That is not a handshake. That is infrastructure access at planetary scale. On March 31st, Convera, the company formerly known as Western Union Business Solutions, signed a partnership with Ripple to settle cross-border payments on blockchain. Convera handles $190 billion a year across 140 currencies. Their CEO, Patrick Gauthier, who used to run Amazon Pay, called Ripple a clear leader in the crypto space. Then on April 1st, 2 things happened on the same day. Ripple turned on digital asset capabilities inside Ripple Treasury, the G-Treasury platform they acquired for $1 billion. That platform processed $13 trillion in fiat payments last year. $13 trillion. All of it was fiat until now. For the first time, Fortune 500 CFOs can hold and manage XRP and Ripple's stablecoin right alongside their regular cash in the same dashboard. Same day, the Office of the Comptroller of the Currency, the agency that regulates national banks, finalized the rule-expanding trust bank charters to include digital asset custody. Ripple's conditionally approved bank charter, granted in December 2025, can now move toward full operations. That gives institutions a federally regulated Ripple entity to work with for the first time in history. 4 catalysts in 30 days, and the price went down. That gap between what the company is building and what the token is doing is the single biggest story in crypto right now. And the answer is buried in the data, so that's what people are saying. Let me show you what's actually happening. Here is what the institutions are actually doing, and it is not what you might expect. Goldman Sachs, one of the biggest investment banks on the planet, built a position of $153.8 million in XRP. They spread it across 4 different exchange-traded funds. That makes them the single largest disclosed institutional holder of XRP through ETFs. Goldman doesn't make $150 million bets on accident. But the broader ETF picture deteriorated fast. XRP exchange-traded funds launched between September and December of last year and pulled in $1.4 billion in their first 2 months. That was historic. 43 consecutive days of inflows, not a single outflow day. Then the tide turned. In March, those same funds lost $31 million. Assets under management dropped from a peak of $1.24 billion in January to roughly $947 million. On some days in late March, all 7 ETF products posted 0 inflows. 0. When the products designed to bring in institutional money start bleeding instead, that tells you the environment has shifted. Now here is where it gets interesting. While the ETFs bled, the whales were doing the opposite. Exchange supply, the amount of XRP sitting on exchanges available to sell, dropped 16.28% since February of last year. That is a massive withdrawal. In early March, whale wallets added 1.3 billion XRP in just 48 hours. On March 10th alone, $738 million worth of XRP moved off exchanges into cold storage. Let that sit for a second. ETFs shrinking, retail scared, and the biggest wallets on the planet are quietly loading up. That is a divergence. And divergences like this usually resolve with a big move in one direction. This is where most channels cut to the subscribe button. We're going to do the opposite. Okay, here's the part where I might lose some of you, but I'd rather lose viewers than mislead them. The reason the token is not moving with the company comes down to one word: plumbing. Almost every major deal Ripple signed this quarter runs on RLUSD, their stablecoin, not XRP. Think of it like this: Ripple built a brand new highway system. It is fast, it is global, it connects banks and payment companies in 60 countries, but XRP is not the vehicle driving on that highway right now. RLUSD is. The Convera partnership uses what they call a stablecoin sandwich. Payments start in regular currency, settle through RLUSD in the middle, and arrive in regular currency on the other end. XRP is not part of that sandwich, not yet. And it gets worse. 88% of RLUSD's $1.56 billion supply sits on the Ethereum blockchain, not on the XRP ledger. That means most of Ripple's own stablecoin activity doesn't even touch XRP's network. In Q1, Ripple's prime brokerage revenue tripled. Payment volume crossed $100 billion. But here is the part that most holders don't understand. XRP holders don't share in those earnings. Equity holders do. The bridge that connects Ripple's corporate success to actual XRP demand is something called on-demand liquidity, where XRP is required as a bridge asset to move value between currencies in real time. That bridge is still switched off in most corridors. It cannot legally turn on at scale until the Clarity Act classifies XRP as a commodity under federal law. The company is winning. The token is waiting, and the distance between them is the plumbing that hasn't been connected yet. All right? That's the data. Now let me tell you what's fighting against it. Right now you're probably thinking, if all of this is true, why is the price falling? That's exactly the right question, and the answer has nothing to do with Ripple. Let me take you 30,000 feet up, because from up there, the picture changes completely. The force crushing every risk asset on the planet right now is not crypto-specific. It is an oil shock. The Strait of Hormuz, the narrow waterway between Iran and Oman that normally carries 20% of the world's entire oil supply, is effectively closed. Iran has been attacking ships since late February. Traffic through the strait is down more than 90%. Brent crude, the global oil benchmark, is above $109 a barrel. The American benchmark, WTI, topped 114 last week. That is nearly double where it started the year. On Sunday, President Trump gave Iran an ultimatum: open the strait by Tuesday or face strikes on power plants and bridges. Iran responded that the strait stays closed until full war compensation. Oman is mediating. Nobel Prize-winning economist Paul Krugman told CBS News, "It is not crazy to see $200 oil if this drags on. If the strait reopens in the next 1 to 2 weeks, oil could crash 30 to 40% overnight. If it stays closed past mid-April, the world loses 5% of global oil supply, and that number doubles by late April according to BCA research. That feeds directly into inflation. And inflation feeds directly into the Fed. The Federal Reserve, the people who control interest rates in America, met on March 18th and voted to keep rates exactly where they are, 3.5% to 3.75%. Chairman Jerome Powell said the country faces an energy shock of some size and duration. Their preferred inflation measure, Core PCE, which tracks the prices of everyday goods minus food and energy, was revised up from 2.5% to 2.7%, moving the wrong direction. They now project one rate cut for all of 2026. Markets had been hoping for 3 or 4. Powell's term expires May 15th. His expected successor, Kevin Warsh, supported rate cuts in 2025, but has gone silent since oil spiked. When rates stay high, money parks in safe assets like treasury bonds. It does not flow into risk assets like crypto. Every bullish catalyst Ripple delivered this quarter got swallowed by a force that has nothing to do with blockchain, nothing to do with the SEC, and everything to do with what is happening in the Persian Gulf. All of this is real. And yet XRP is trading at $1.31. Fundamentals set the destination, macro sets the timing. But pay attention to these next three. They explain the tension under the surface. 60% of XRP's circulating supply is held at an average cost of about $1.44. That means every time the price pushes toward $1.40, it runs into a wall of millions of wallets that have been underwater for months. Those holders are not buying more. They are waiting to break even and get out. That resistance is not a line on a chart. It is millions of real people making the same decision at the same price. Below the current price, support sits at $1.28. That level has held through every sell-off since February. If it breaks, there is very little buyer support until $1.15. On the upside, XRP failed to hold $1.35 on April 1st. The 50-day moving average sits at $1.38. Heavy institutional selling starts between $1.45 and $1.50. RSIE, a measure of how oversold an asset is, reads 38. Weak, but not extreme enough to trigger a technical bounce. The Fear and Greed Index reads 9. 9 out of 100. That is extreme fear, the kind of reading you see maybe 2 or 3 times a year, and liquidity on Binance, the world's biggest exchange, just fell to multi-month lows. Time for the cold water, because what I'm about to show you is what the hype channels leave out. Think of these next 3 price levels as gates in a locked corridor, each one guarded by a different crowd of sellers. Gate 1, $1.35. XRP has been rejected here for 10 straight days. Every attempt to reclaim it has failed within hours. Gate 2, $1.44. This is the cost basis wall. The majority of holders break even here and sell. Getting through it means absorbing pressure from millions of wallets. Gate 3, $1.50. The 50-day EMA and the level where institutional desks have consistently distributed. To clear all 3 gates, you don't just need good XRP news. You need the macro to shift. You need the plumbing to get connected. 2 conditions unlock it. First, the Clarity Act passes. That switches on-demand liquidity on across Ripple's $100 billion payment corridors, creating real, recurring transaction demand for XRP. Second, oil drops. That gives the Fed room to cut. Money rotates back into risk assets. Both are binary events. Both have deadlines inside the next 3 weeks. That's the full picture, bull and bear. Now let me give you the playbook. Here's how you stop guessing and start watching the right things. Signal 1, the Strait of Hormuz. Trump's Tuesday deadline is the first inflection point. Watch Brent crude. If it drops below $90, pressure on the Fed eases and crypto gets room to breathe. If the strait stays closed past April 19th, we enter a supply crisis that reprices everything. Signal 2, the Clarity Act. The Senate returns from Easter recess on April 13th. The Banking Committee has been targeting markup for the second half of the month. If the bill clears committee, Standard Chartered's year-end target of $2.50 for XRP comes back into play. If it stalls, analysts at 24/7 Wall Street project a drop to $1.15. This bill is the switch that turns the plumbing on. Signal 3, ETF reversal. Watch for 2 consecutive weeks of net inflows into XRP exchange-traded funds. March was all outflows. Goldman already built their $153 million position. The question is whether the rest of Wall Street follows before or after the catalyst arrives. Signal 4, the Fed. Next meeting is April 28th and 29th. Watch the 2-year Treasury yield. If it drops below 3%, rate cut expectations are rising and money is preparing to rotate. If the yield stays flat or rises, the macro cage stays locked. Bullish scenario, Hormuz reopens, Clarity Act clears committee, Fed signals a cut. XRP breaks above $1.50 and targets $1.60 to $1.80 by month end. Standard Chartered's 250 year-end target stays alive. Bearish scenario, straight stays closed, oil hits 150, the bill stalls. XRP loses $1.28 support and slides toward $1.15. You don't need to guess, you just need to watch these 4 signals. So let me bring this all together. Ripple built a $50 billion financial infrastructure stack, Mastercard, Convera, a national trust bank, 13 trillion in treasury volume. The token that carries its name is trapped, not because the fundamentals are broken, but because the plumbing between the company and the token hasn't been connected, and a macro storm is keeping everything frozen. 3 events in the next 3 weeks break the deadlock: the Hormuz resolution, the Clarity Act vote, and the Fed meeting. When the plumbing connects and the macro clears, the price catches up to the fundamentals. The only question is the timing. I'll be covering every development: the Hormuz situation, the Clarity Act markup, the ETF flows, every single day on this channel. Tomorrow, XRP Tokyo kicks off in Japan. Ripple's leadership presents new updates on real-world asset tokenization. The XRP ledger already hosts $2.3 billion in tokenized assets, up from $991 million at the start of the year. That number more than doubled in 2 months. I'll have the numbers. I'll have the breakdown. Don't miss it. This is the quiet before the move. Stay ready. Stay sharp. This content is for informational and educational purposes only. It is not financial advice. Always do your own research before making any investment decisions. Until next time, stay sharp, stay informed,